Good afternoon. My name is Olav Jones. I'm Deputy Director General at Insurance Europe, and it is my pleasure to open and moderate this session on pension resilience in Europe. Insurance Europe's 2020 Pan-European Pension Survey found that almost half of survey respondents were not saving for retirement, and 42% of those not saving said they could not afford to, and maybe more worryingly, 28% said they were not interested. This raises some concerns considering Europe's population is aging. In the EU, there will be 2 people of working age for each person retired by the end of the century. This compares to over 3 today. So I think we'll have an interesting discussion and panel today, but we'll start off with today's session with a recorded introductory speech from Dubravka Šuica, European Vice President for Democracy and Demography. Thank you.
Dear ladies and gentlemen, it is my pleasure to address Insurance Europe and your multi-stakeholder federation. As the first ever European Commission Vice President for Democracy and Demography, this Commission prioritizes the demographic issues affecting people's lives. In my role, I focus on the whole life cycle, from the rights of children to those of older people. One of the key demographic trends across the European Union is aging. This is not just a matter for older people. Everyone is impacted directly by the prospect of living a longer life, including the young. Aging creates both challenges and opportunities for economic growth, fiscal sustainability, and pensions. The COVID-19 pandemic has presented additional challenges. The need for solidarity should be the one lesson we learn from the pandemic. This includes fostering intergenerational solidarity and responsibility with enabling policies. Indeed, a firm commitment and engagement of young and older people is necessary. Today's discussion is timely and allows us to look at the insurance industry's current and future contributions to increasing retirement security in the European Union. Pensions are a key part of this discussion and one of the questions we addressed in the Green Paper on Aging. It is clear this discussion must involve insurers who are major providers of pension products. In the European Union, over the last 50 years, life expectancy at birth has increased by 10 years for both men and women. This, combined with the fact that we both live longer and in better health, is a major achievement of our social market economy. Today, 20% of the population is above 65. By 2070, it will be 30%. The demographic trend is clear. The number of older people is set to increase further in the future. The Green Paper on Aging, adopted in January, launched an EU-wide discussion on aging. Its public consultation closed on the 21st of April. We are currently analyzing the input and considering possible policy responses so the European Union can concretely support member states in their policy making. Member states already recognize the need for change, as some have been adapting their pension systems. And these changes are key elements of a debate on making pension systems in a demographic environment that has significantly changed since the inception of pension systems. We need to look at novel ways to make our policies fit for purpose in an era of major change ranging from the twin green and digital transitions to new form of work, and must include lessons learned from the COVID-19 pandemic. The Green Paper takes a life cycle approach and reflects the universal impact that aging has on all generations and stages in life. The full title of the paper is Green Paper on Aging, Solidarity and Responsibility Between Generations. This highlights the importance we attach to addressing intergenerational fairness. Future generations will face the impacts of a shrinking working age population. The old age dependency ratio will sharply increase over the long term, with less than 2 persons of working age for every person aged 65 and more by 2070. This is underpinned by the recent Aging Report on economic and budgetary projections for European Union member states. Furthermore, the Pension Adequacy Report and the Report on Long-Term Care are being finalized and will be made public mid-June. Workers who enter the labor market early risk having negative outcomes both in terms of benefits and potentially having to work longer. We must continue supporting and protecting family-related career breaks and phasing out preferential pension schemes. Pensions allowing for dignified living standards in old age should be available to those who are unable to have longer working lives in the future. This could be achieved through pension credits, minimum pensions, pensions based on residence, and, as a last resort, social assistance. Ensuring that pension systems cover different types of economic activity would help safeguard their adequacy and contribution base. High-quality, safe and cost-effective supplementary pensions that complement statutory pension schemes can provide much-needed additional retirement savings. Complementing state-based pensions by supplementary pensions and developing multi-tier pension systems is key to ensuring an adequate, sustainable income in retirement. The extensive development of supplementary pensions throughout the European Union could ease the burden of national pension budgets, foster adequacy and sustainability of national pension systems, and ultimately contribute to higher pension income. Another important concern is how to ensure adequate pensions for those who spend large parts of their working life in unremunerated work, particularly women. We have seen this during the current pandemic, where many women took on increased care responsibilities. This leads from a pay gap to a pension gap, which we also look at in the Green Paper on Aging. Private providers like insurers can help improve the retirement income of citizens in a number of ways. The insurance and pension sectors are well placed to provide long-term financing. The main objective of pensions is to provide income after retirement. However, private pension providers also play a role in the economic recovery as investors. To play that role fully, we must make sure that pension systems are sustainable. The measures outlined in the Commission's Capital Market Union Action Plan focus on complementing Member States' efforts to foster adequacy of their pension systems. The pension tracking systems will facilitate access to individualized pension information, making people aware of their future pension income and the need to save for retirement. I'm delighted with the progress of the pan-European personal pensions. On the 22nd of March this year, the Pan-European Personal Pensions Regulatory Technical Standards on the cost cap, the key information document and the risk mitigation techniques were published. I hope we can reach agreement and publish the rest of the package in the coming weeks. Insurers and other pension providers can contribute to addressing the two important problems pan-European personal pensions aims to tackle: the European Union investment gap and the pension gap. Regarding the longer-term role of the insurance and the pension sector in societal resilience, I'm convinced that private pension providers can contribute to many aspects of our work. My colleague Commissioner McGuinness already discussed the relevance of the regulatory framework in the supporting resilience. I want to highlight the Commission's effort to ensure that the forthcoming review of Solvency II successfully addresses the challenges of our times in a balanced way. In synergy with the Green Paper, the European Pillar of Social Rights Action Plan, adopted on the 4th of March this year, is one of our main vehicles to boost equality-based, solidary and dignifying solutions to the issue of aging. It sets out a number of principles related to areas impacted by aging, including old age income and pensions, as well as essential services for older persons. At the Porto Social Summit of 7 to 8 May, EU heads of state and government recognized the Pillar Action Plan as the guidance for the coming years in the areas of employment, skills, health and social protection. Dear ladies and gentlemen, addressing demographic trends such as aging is key to responsible and responsive policymaking. Policymakers must strike the right balance between sustainable solutions for our welfare systems and strengthening intergenerational solidarity and fairness. We need a forward-looking reflection on the impacts of aging and policy alternatives inside the European Union and also for Europe's role in the world. The insurance and pension sector will play an important role in addressing the challenges facing our society and economy. With that in mind, I would encourage you to contribute to the recently launched conference on the future of Europe. There is a space there for you to organize events and start a conversation in your area of expertise. I look forward to our continued engagement in building a fair and inclusive future. Thank you.
Thank you very much, Commissioner Suica, for this introduction. It is no surprise that pensions are high on the EU agenda, and we at Insurance Europe are certainly looking forward to engaging with the Commission on this topic. But before we start our panel discussion, a quick word about logistics. The audience members can see on their screens a place where they can submit questions to panelists, and we will use these questions at the end of the session. So I would encourage people to start entering and thinking about those questions from now on. Now let me welcome and introduce our panel of distinguished speakers. Firstly, we have Panos Tsatsloglou, Deputy Minister for Social Insurance at the Ministry of Labour and Social Affairs in Greece, Hilda Vanayan, President of Assuralia and CEO of P&V Group, and Kyriakos Apostolidis, General Manager for Greece and Cyprus at MetLife. Welcome. I will start our panel with quite a general question. Pensions are typically grouped into three pillars: state pension, occupational pensions, and private pensions. How do you see the importance of a multi-pillar pension system in ensuring pension resilience? Maybe you can comment on where we stand in your countries or more generally in Europe, and whether any further actions are needed. Hilda, could you kick us off?
Thank you, Olaf, and good afternoon, everybody. And thank you for giving me the opportunity to talk in this panel. Well, yes, I do think a multi-pillar pension system is quite important to make it as resilient as possible for the future. In Belgium, we started with a second and third pillar of pension early in the years 2000, and even the third pillar even earlier. The system is like this. It's a second pillar for employers, so they do organize pension schemes for their employees, and I have to say it's quite successful, as a lot of industries did organize supplementary pension programs in their sectors. In actually 75% of the employees do have a kind of second pillar pension cover. It's still not sufficient, of course. There's still a lot to be done. We would like to have all employees having a certain kind of second pillar pension. And of course, the saved amounts for those people is, in a lot of cases, not sufficient to ensure a dignity, a good pension afterward. And then the third pillar, so individual savings for pensions, has been incentivized by tax measures, so that worked a lot as well. But of course, that are more smaller amounts, but also here quite successful, as 3 million Belgian people do have a third pillar today. And I do think it's very important to have this multi-pillar system, as you are combining repetition system and a capitalization system, and that way you do limit financial risks for those people. But we do think there is still a lot to be done, as well as was made clear in the introduction. The aging of the population conducts to a lot of stress on the statutory pension systems on the one hand, and on the other hand, the second pillar, as I said, is still not sufficient to allow a good complement for everybody to make sure they can have a sufficient pension to live well after their retirement.
Kyriakos, do you have anything to add from an industry perspective on that?
Yeah, good afternoon and thank you for the invitation. I wanted to add that the answer to this kind of difficult questions lies on two things: facts and uncertainties. And I'll take the chance to remind ourselves what are the facts that we are dealing with here. So, a couple of numbers. We shouldn't make this discussion too technical, but certain numbers are important. So for Greece, the dependency ratio today is 38%. By the end of this decade, it will be 46%. And by the end of 2040, it will be 58%. So in a nutshell, the retirees will be more than the active contributors in the system. The second piece is the longevity piece. Today, we have on average 20 years of living through retirement. We are going to have, by the end of this decade, 21.5 years of retirement, and by the end of 2040, 22.5. So again, the simple conclusion is that we need to fund longer periods of payouts. Now, in a good scenario, and I'm talking now about the uncertainties, you might see partial offsets of these headwinds that we are facing through the facts by the employment rates or the average contribution. But you cannot really be certain about this today. The other piece of uncertainty is the asset returns on managing these type of assets, which are diminishing so far. And I don't think we can have a good degree of certainty that the compound effect will be a tailwind for us. So I'm just refreshing ourselves on the things that we all know, just to prove that, the multi-tier approach in both pillars is essential, and time is not a friend for us, given this set of trends that we are facing. So we have every reason to make a plan of integrated pillars and try by this type of synthesis to really secure an adequate replacement income based on the facts that we are recognizing for the citizens and the societies. Now, within this framework of actions, we should also take care of tax equalization items and incentivization schemes for citizens.
Thank you very much. I think you've highlighted both the need and the big challenge ahead of us. Panos, I understand in Greece that you have done a lot of research into changing the supplementary Pillar 1 pensions from a redistributive pay-as-you-go system to a capitalization system. Can you share the outcome of that work and what you plan to do as a result of it?
Thank you very much, Olaf, and I would like to thank the organizers for the invitation. Currently in Greece, social insurance pensions, both main pensions and auxiliary pensions, supplementary in your terminology, follow the distributive model, and as such, they are hugely exposed to the demographic risk. Kyriakos already gave some numbers regarding this risk before. Therefore, we plan to introduce legislation aiming to gradually transform the auxiliary pension system from an NDC to a fully funded one. There are four main reasons motivating our initiative. The first one is risk differentiation. Social insurance is primarily a form of insurance, and the most well-known principle of insurance is, as we all know, that we should not put all our eggs in one basket. In the new system, the social insurance pension will have finally three components. One, the so-called national pension, will be funded by the budget, and this, of course, will be subject to fiscal. The the second component will be the main distributive pension, which will be funded by the contributions of the current workers. And of course, this will be current to the demographic risk. Finally, the auxiliary pension will be funded by the contributions and the returns to the investment of the pensioner himself or herself. And this will be, of course, subject to market risk. Taking into account that these risks are not perfectly correlated, it is clear that the overall risk of the pension income declines accordingly, and this is a very welcome kind of a fact. The second reason that we are introducing this change in legislation is that it has to do with pension adequacy. Despite the fact that the returns to funded systems are likely to have higher variation than the returns of unfunded systems, the experience of many countries with mature funded systems shows that in the long run, the returns are substantially higher than those of distributive systems, especially distributive systems of aging societies. Hence, we anticipate that the pensions of the new system will be higher than those of the current system, leading to higher standards of living during retirement for the future pensioners. The third reason is that a substantial part of the contributions of the new system will be invested in the Greek economy, thus boosting productivity, wages, employment, and GDP, and indirectly boosting future pensions as well. Finally, one of the perennial problems of the Greek labor market is the existence of a large segment of uninsured labor. The new system will provide strong disincentive for this kind of activities, leading to better functioning of the entire economic system, as well as helping to restore the young workers' confidence to the social security system itself. This is, in a nutshell, the rationale for this reform, and this is what we are aiming to do.
Thank you. An ambitious project, and I think you've highlighted some of the benefits that can come not just from addressing the pension gap, but also how that can boost the economy, something the Commissioner also mentioned in her introduction. But I would now turn to a point that Kyriakos mentioned about incentives and the role they can play. But I will first ask the audience, in fact, this question through through a poll. So I think the audience should see that on their screen. And so we're going to ask the question: what would be most likely to make more people save for retirement? So please choose one of the answers listed. So I think we'll freeze the survey there, but we can see that two of the answers are particularly prominent: the clearer understanding of how much people need to live on and therefore save for their retirement, and the tax incentives. So now I'm going to turn to our panelists and ask them a similar question. So clearly there are several ways one can make it easier or incentivize people to save and thus improving pension resilience. In your view, what is most critical? Do you agree with the audience? Starting maybe with Kyriakos, if you could start us off.
Yeah. Sometimes we are mixing the tools with the fundamental issues, and we think that both of them have equal importance. If I was to cherry pick the first, and dominant factor for this, I would say the education / the cultural shift. And to this latter thing, I think the Greek government is taking, brave steps through the reform that Mr. Tsakloglu explained before. But there is a broader need to explain to people in various stages of life that, they'll have to take more control of their destiny. And sometimes you need to explain why these things are happening and what are the things that are really affecting people in today's world, which is much different than, the previous generations that lived in a very different environment in terms of risks and rewards. Now, the cultural shift is a bit more complex because we'll have, I know it's painful, but we'll have to disembark by this decades of culture of the father state figure, simply because, the state funds are not infinite. And if there is a priority for reallocating these funds, it's towards investments that will actually and ultimately raise the asset part the system, more contributions, in other words. So if I was to cherry pick one thing, that would be the first one. And then I would say that the second one is transparency. The more we share with people, either this is access, or this is description, or this is enrollment in terms of transparency steps, the more we fight this kind of suspicion or this feeling of uncertainty or this wondering about the needs.
Okay, thank you. Maybe Panos, to pick up on specifically the tax treatment and something that the governments can have under their control. I understand in Greece the tax treatment of the benefits paid out under the second pillar are very different depending on whether the funds are autonomous pension funds or private insurers. Can you explain the rationale for the different tax treatment and whether there are any plans to change this?
Yes, Olaf. Before I will reply to your question, but if it is possible, could I go back to your previous question? I agree absolutely with Kyriakos. However, let me answer to this question in a different way. In my real life, I'm an academic and not a full-time politician. And there are two things that stand out in these questions that you were asking there. One is that we need to provide citizens full information. And this information is missing now. We need to help them understand the importance of savings for sustaining a decent standard of living in retirement. Time after time, we have seen it in surveys all over the world that people start realizing that they need to save more for retirement only when it is too late. Therefore, some state coercion through mandatory pension schemes is certainly desirable, and the resilience of these schemes certainly needs to be strengthened, as I mentioned in my introduction. The second thing, and this is related to your question, people do react to incentives. From this point of view, tax incentives do play an important role in motivating private savings for retirement and should be encouraged, although we must be clear here that there is a question of equity issues here, in the sense that most of the people who benefit out of these savings normally belong to the top end of the income distribution. Now, regarding the comment that you made about taxation, normally benefits of group pension plans in Greece are taxed in the range of 10 to 20%, and autonomous pension funds do not have a preferential tax treatment vis-a-vis private insurance when it comes to annuities. Indeed, an anomaly does exist in occupational funds lump sum payments. And indeed, once we finish with the reform of auxiliary pensions, we plan a long overdue reform of occupational insurance. Besides removing the preferential tax treatment of lump sums versus annuities, which is really not understandable, we plan to make provisions for a level playing field there, and we will take all these issues that you mentioned there into account.
Thank you. Hilda, we've heard from both the audience and the panelists so far the importance of education and I think also of informing the citizens about, in terms of transparency, of how much they've saved and the potential impact. We've also heard about the potential role of tax incentives. I know in Belgium there is a portal that allows people to look at their total pension, or tries to take a step towards people seeing their total pension picture across the different parts of their landscape. Do you have any views on what would be most effective in incentivizing people to save more or save enough?
Well, I can only agree with that point that we need to make sure everybody is aware of the need of saving more. And you referred to that information system that was set up by the government in Belgium, which is quite effective from my point of view. So everyone at any point of time can consult on that system how much they will get as a statutory pension and how much they will get from their second pillars or third pillar is not yet there, but it's the purpose to bring it in there as well. So today it's a statutory and the second pillar. So it gives you a good view on the replacement rate of income after retirement, and from there, then you can decide to save more or not. But at least you are informed about the system. Still, there is also a lot of education to be done on how it works and how you get there. So we would like to see it in all kind of education on a part of education on financial systems, but still a lot of work to do, but we're working on it.
Okay. Then moving on to another topic, this was Kidokos. You mentioned this in your earlier statements about the uncertainty of market returns, and of course, in the current low interest rate environment, the expected returns, at least at the moment, are very low compared to what it was in the past. How do insurers deal with this, and do products with a guarantee still have a future?
That's an interesting question. You should think about three parameters here. One is the interest rate environment, the second, and the respective volatility of this. The second one is the capital treatment of various asset instruments, and the third one is the Solvency II regime. So with the current rates, I don't see the industry has, big appetite for long-term guarantees, simply because the volatility and the risk is not attractive enough. And you might end up with complexities once we're talking about promises made for the next 30 to 40 years. Now, the second piece is that still there is no symmetry in terms of asset instruments. So to give you an example, if you have reserves on sovereigns, it is much different in terms of capital treatment than your reserves on corporates. And that is something that we would like to revisit with the European Union and the Greek government and get the necessary consultation to see how we can apply a fair rule, which basically says, equal grade of risk, equal capital treatment. And then the Solvency II regime, it's not the first time that we say this, and we are working with the European bodies to see how we can, end up with a review of the Solvency II regime, which will bring a more effective balance between the risk reward. The current regime actually overstresses and over-penalizes insurers, but they would like to offer guarantees. If you see, and again, I'm not going to make a technical discussion here, but if you see the stress scenarios that we are taking based on Solvency II regime, I think, we are overreacting there. So we'll have to review. But these are the three parameters that really dictate today's environment. And if we want to see different options, you might, for example, see certain floors and ceilings, certain corridors for a kind of guarantees, provided that insurers can have a better balance under Solvency II and capital treatment of various asset classes.
Thank you. Hilda, to you too. Do you see also see Solvency II playing a key role here?
Well, yes, for sure. I can only agree with the need to review Solvency II in terms of capital requirements for long-term investments. But maybe coming back on your first question on guaranteed schemes for pensions, given the low rate environment, I do still think it's important for people to have a certain view on the kind of return they will build up on their pension schemes. So I do think it's still important to try to give a certain guarantee, but of course you must be able to offer it. And what we have seen in Belgium is, of course, insurers lowering those guarantees. But up to now, they were still able to give quite good return based on discretionary profit sharing, so which is also under Solvency II, then asking less capital. But I do think for the future, it would be good to have a kind of, guarantee that is moving with the financial markets and with inflation, but still trying to give a certain guarantee, especially as in Belgium, the organizers of the pension schemes, so most of the time employers, do need to guarantee a rate on all new payments in that pension scheme. And today that rate is still 1.75%, which is quite high, given the low interest rates we have all over Europe, but in Belgium even a little bit lower than in Greece. So we see a movement to non-guaranteed pension schemes, but still the most of them are, well, I must say 80% of the reserves are still guaranteed pension schemes. So yes, important, and that stressed even more the importance of having investments in front of that are covering those long-term engagements. And yes, indeed, as it was said before, we would need a different treatment of capital requirements for those long-term investments under Solvency II.
Thank you. I think the situation in terms of guarantees does vary across Europe, but in our pension survey, we certainly found that across the 10 countries and 10,000 people we surveyed, that the security of the pension, the safety of their investment was actually the number one concern in terms of their pension scheme. But maybe moving on to another element of concern, which is the universal pension access and resilience. And so maybe, Panos, if as a policymaker, if you could give us a view to how we can get to a stage where we have pension resilience for all, in particular to protect the most vulnerable groups, and such as those not in standard forms of employment, also ensuring women are given equal treatment. And I think this is especially important following the strains on the economies and individuals following the COVID-19 crisis.
Yeah, thank you, Olaf, again. First of all, I would rather prefer to open the frame of the discussion. Pension is probably, let's say, only in the later stages of our life. However, pensions will depend crucially on our performance in the labor market before reaching this particular age. Therefore, before reaching the pension stage, we should look at the individual's working life and perhaps even earlier, and focus on policies aiming to improve his or her productivity and earning capacity, better education and training, as well as incentives to participate longer in the labor market may be part of this menu. If we are successful, the resulting higher incomes will boost both social insurance contributions and private savings, and thus provide a better cushion for better life. That is, we should not isolate pension from the rest of our working lives. Now, when it comes to old age, we need certainly to strengthen all pillars of the pension system, increase their risk differentiation, as well as thinking hard on how we can contain health and long-term care costs that, according to some projections, may rise exponentially in the future, thus not leaving too much space for pensions and so on. Now, definitely in many countries, including Greece, we have introduced guaranteed pensions for elderly individuals. In some countries, Greece is an example like this. We have universal pensions of this kind. That is, everybody reaching a particular age who has participated in the labor market receives the so-called national pension in Greece. It exists in other countries in different names. In some other countries, this is part of the social assistance general scheme and so on. It is true that all these schemes are quite good at alleviating extreme poverty among the elderly. On the other hand, I must admit that especially the universalistic types of schemes like them are quite expensive. And taking into account the graying of the population, they are likely to become quite challenging to meet their obligations in the future. On the other hand, from a political economy point of view, the situation is quite difficult in the sense that these schemes are particularly popular among the elderly population. We live in democratic societies, and more of the voters will belong to this particular group. Therefore, the role of education from this point of view is also of crucial importance.
Hilda, I mean, we've heard from Panos some of the policy actions that have been taken or could be taken. Do you see the insurance industry, playing a role also in helping to address the universal access to pensions and helping certain vulnerable groups?
Yes, I do think that the insurance industry could play a role in there as well. And of course, we need those government actions to incentivize the different industries to step in supplementary pension schemes, especially for vulnerable groups. But I do think that insurers can play that role as well, stepping to their clients and explain how we can address those differences between different groups of the population. So I do think about, well, of course, it has been said, the difference between men and women, which is, of course, also a reflection on differences still on the labor market, but also a lot of differences between blue collars and white collar workers. So I do think it's very important that insurers can explain this to clients and try to build up solutions with them which are affordable as well for the employers, because that will be a question, of course, on how can they switch. And here we then are speaking about everybody who is employee within a certain industry, but you do also have self-employed people or people working in very small companies, and those are most of the time forgotten. I mean, so we also need to make sure that those people who get the information are informed about what they can do about it and so on. And so I do think, yes, the industry can also play an important role in there.
One of the other key trends we've seen is the change from defined benefit pensions to defined contribution and the sort of disappearance across many sectors of the defined benefit. These pensions had the advantage they guaranteed a certain minimum sum. Do you have any other comments in terms of other steps any concerns about this, or any other comments about steps that can be taken to make sure that a reasonable pension is obtainable and guaranteed across the population?
Well, I think indeed we have seen that shift to defined contribution plans. This is a way for employers sometimes to lower their remuneration cost within the company, but certainly as well to control the cost of the pension schemes, because in a defined benefit scheme, you see actually an exponential raise of those costs as your employees are getting older. So a way to control the cost. But I do think we should have a discussion on the global salary cost and remuneration cost, including contribution for pension schemes. And there, I think it's a work to do by all stakeholders, governments, employees, and employers to find a kind of agreement to finance the pensions of the workers for the future. But of course, our employers need to be able to finance this. So it's kind of finding a better balance in what you are earning now and what you're saving for the future.
Okay. Maybe we'll have one more question before we turn over to the audience questions, which I see are building up. And so please put in your votes. If the audience can put their votes in for the existing questions, we can see which ones we tackle first. But maybe one question to Kyriakos. The pan-European pension product has been developed, and a lot of effort has gone into developing that, and it's due to be launched soon. But views vary quite a lot on this project. In your view, can the PEP play a significant role in improving pension resilience?
Yeah, if I can comment on the previous two, because I was listening to Mr. Tsakloglu today, and I thought I would have a couple of comments. So going back to the vulnerable groups, I think it's worthwhile, first of all, to stress the brave step that the Greek government takes now with the new labor law. So one thing when it comes to vulnerable groups is to give them more opportunities for a better future at work. And to the credit of the state, this is now kind of happening. That's one piece. The second piece, I think Mr. Tsakloglu is right, pinpointing the fact that pension is at the end of the life cycle. And before that, we need to take a closer look to these groups and see what are the primary needs. Through consecutive surveys, this cluster might get completely derailed from a small health incident because they are simply not able to finance this. And to this end, maybe we should take a closer look on the health area and how the private sector and the state can co-fund the offer of services at an affordable price, and rationalize the medical cost through the DRGs. Now, finally, going back to what Mr. Tsakloglu said about the tax incentives, I fully agree that there might be a distortion for higher income earners, but I would also add to this kind of rationale that we might think how we should reallocate state benefits to the vulnerable groups more, and then compensate with tax incentives people who can, really afford a tax incentive, because the vulnerable groups, even if they have it, they cannot use it. So it's an interesting discussion, and I think the concept of reallocating the funding available, using also the potential funding from the private sector, is a discussion that we should continue, because most probably we are going to need all the available funds to build a multi-tier approach. Now, go to the PEP. First of all, it's towards the right direction, we think, as an industry. It serves a product or a value proposition that has common ground and hopefully similar rules. And to this end, it will serve similar needs. I think that the portability feature of the product, combined with the recent trends that we see on the future of the work and the dislocation from geographies, have an alignment. And therefore, we are encouraged to adopt this as a direction. Now, as always, the most important piece is to make sure that we have country alignments in terms of decrees, because this is where you see the details, especially when you try to have transparent rules, low barriers to entry, and freedom of asset choices. I would add to this that the pan-European pension product is an interesting opportunity to be combined to the ESG global and European initiatives to create attractive investment classes that insurers, such as the industry in the whole Europe, will fund long term, therefore ending up to reshuffle the sovereign book with longer term investors.
And Hilda, will you be, are you looking into offering a PEP?
Not really at the moment, I must say. Not quite sure that PEPs will have that much success in countries where the third pillar is well developed already. So we'll see. Of course, it's there, but yeah, it's not on our priority list for the moment.
If I am allowed to have a more general comment here, we are talking about a common European labor market, and indeed barriers, legal barriers at least, do not exist for decades now. However, we do not really have a real such market. There are several reasons. There may be linguistic barriers, there may be social habits, there are several other things. However, one of the most important barriers is pension portability. From this point of view, I have the feeling that this new instrument that we have in our disposal, that is the PEPs, is likely to contribute positively in this direction, help facilitate labor mobility, and this will be a beneficial result for the European economy as a whole, besides the benefit for the pensions industry.
Okay, I think we'll be following the course of the PEP carefully over the next few months and years. But in the time we have left, I'd like to turn to the audience questions, and starting with the one that I think has come at the top of the list. The question is it a role for the government to provide for an early warning system for individuals heading towards pension shortfall, i.e. they're probably unlikely to have enough money in their retirement? Maybe would anyone like to start with that one?
I think we kind of spoke of this indirectly in our discussion so far. And, Mr. Tsakloglou represents the state in this discussion, but if I was to share a view, I think there is a common role for the state and the private sector to educate people, not necessarily give warnings. We'll have to start, look at the poll results at pan-European level. People should understand the need before they get the warning. So I would suggest, to put more time, spend more efforts on how we can explain better to people why do they need to take a better control on their destiny.
If indeed Kyriakos is right, I'm a member of the government, therefore I can say a few things here. Definitely the notion of transparency is of absolute importance. On the other hand, I must admit that this early warning system can play a role, but it is tricky as well. I have seen in several countries, pension calculators in action saying that, if you continue with this particular path that you currently have, you will probably end up with a pension like X or Y and so on. However, we are talking about very long-term projections. They are extremely sensitive to interest rate and several other, both demographic and economic conditions. And I have the feeling that they may create false expectations that may be very expensive in the long term. Therefore, definitely, I agree with Kyriakos in what he said before, that we need to educate people about the benefits of saving both through public systems or private systems, for a better later life after retirement.
Okay.
And again, I would agree with that. But once you have the database, as CIGEDIS is now in Belgium, compiling all the data from the statutory pension and the second pillar, you could easily have kind of, a tool on that, trying to give a few figures on how people could use that money in the future and how much they would need. So, well, never thought about this before, but I think could be a good idea to have this kind of thing so people can ask questions to the system. Would that be enough to cover health problems, for instance, and then just playing with it, because that would contribute to the education. Just a thought. Yep.
Yeah, sorry. Yes, I think this is something that one of the things the Commission is looking into, best practices in terms of information, education and transparency across Europe. One of the other things they're looking into, and maybe that's our wrap-up question, and that's on a pension dashboard, which I think would be focused more on the member states' policymakers than on the individuals, and basically would, I guess, be trying to stimulate policy changes that would address pension resilience. So maybe very quickly, any views on the importance or effectiveness of something like that, which is also something the commissioners are looking into? Maybe Panos as a member state.
Again, that I must say a few things. Yes, this kind of dashboards in the sense that they can identify best practices and we can have transfer of knowledge from one country to another. Also, always, however, taking into account that the social and the economic conditions in one country may be very different than the ones of another that where these perhaps best practices identified. But definitely, I have the feeling that they can have a positive contribution.
Thank you. I think that we'll have to wrap up there. But we've heard a lot of very interesting ideas and had some interesting discussion. I think the challenge ahead for individuals and policymakers is clearly there. Lots of ways in which we can address this, but certainly a lot to do. So on that note, I would like to have a big round of applause, virtual applause to our speakers. And thank you very much for your participation and insights. And also thanks for the audience for joining us and for their questions. We look forward to seeing the audience again for our next Resilience Week session, which is tomorrow, on insurance regulation's role in resilience. We'll be discussing how Solvency II and other regulation governing insurers affects their ability to contribute towards resilience building. Thank you very much.